When the opening trading bells rang this Monday morning, global markets suddenly woke up to a high-stakes reality check. Over the weekend, the standoff in the Strait of Hormuz effectively strangled a major global transit artery. Brent crude instantly surged past $100.12 a barrel, injecting a massive structural war premium directly into the global economy. But at 7:30 a.m. Indian Standard Time, an unexpected counterforce hit the wire. China released its latest data dump, revealing a surprising 6.1% surge in industrial production. This creates what we call a stagflationary pincer. On one side, you have a booming industrial sector demanding more raw materials, and on the other, an energy shock driving up the cost of everything. Central banks are paralyzed, unable to cut interest rates because of soaring oil, but terrified of crushing economic growth. This collision has spiked the global VIX, the market's primary volatility and fear gauge, to an elevated 27.29. Institutional capital is now scrambling in a frantic Monday morning reset, desperately searching for safe ground. The bleeding is most obvious in Western cyclical markets. In the U.S., the S&P 500 is highly vulnerable to triple-digit oil prices, which threaten to ignite a secondary wave of core inflation, just as the Federal Reserve maps out its next interest rate move. The S&P 500 has formed a bearish head and shoulders pattern, testing critical defense at 6,650. Moving to Europe, the German DAX hovers dangerously close to its 23,400 structural support, making it the most vulnerable Western benchmark. Germany's manufacturing core relies heavily on imported energy and smooth logistics. The Hormuz blockade has skyrocketed freight costs, threatening to completely wipe out first-quarter profit margins for European chemical and auto giants. We are also seeing broad risk-off behavior spill into digital assets. Bitcoin, acting as a high-beta asset, moves with aggressive volatility, facing massive institutional deleveraging. Central banks across the U.S. and Europe are locked in a policy deadlock. Unable to stimulate their economies while energy inflation rages, they are watching a systemic flight of capital exit their borders. In Asia, the picture is complicated. Japan's Nikkei 225 opened with a brief relief bounce, momentarily breaking its downward slide as traders digested the positive factory data out of China. But that relief is a trap. Japan is a massive net oil importer. Paying over $100 a barrel crushes the value of the yen, which violently squeezes domestic exporters who rely on stable exchange rates. India is in a similar defensive crouch, with the rupee trading weekly at 92.34 against the dollar and the ballooning cost of imported crude. Domestic traders are adopting a sell-on-strength bias. This chart shows capital movement in the Indian market. Foreign institutional investors aggressively liquidated, pulling out over 6,345 crore rupees. Yet, domestic institutional investors absorbed the shock, deploying over 9,013 crore rupees into defensive sectors, building a domestic wall of money. These Asian benchmarks are not acting as safe havens. They are volatile battlegrounds, where local retail and institutional buying is the only thing preventing a severe market breakdown. So where is all that fleeing foreign capital actually going? A massive chunk is pouring into the Saudi Tadawul Index. It is acting as a direct geographic and economic hedge against the broader crisis. As long as the crude supercycle persists, Saudi equities are supported by massive fiscal surpluses. Traders are banking on record first-quarter dividends from state energy operations, providing a thick earnings cushion that offsets global growth fears. For pure liquidity, the ultimate refuge remains traditional fiat, the U.S. Dollar index is testing the critical 100-point barrier as cash piles into safety. Meanwhile, hard assets are experiencing a massive breakout. Gold surged past $5,158 an ounce as capital aggressively abandons equities in search of physical value. During a severe supply shock, institutional capital flows directly into the specific markets and commodities that benefit from the very inflation causing the global panic. China's industrial beat may have provided a temporary floor for Asian markets, but the blockade in the Gulf remains a binary risk that can override strong economic data in minutes. For the week ahead, the professional mandate is selective defensiveness. This requires actively reducing position sizes in cyclical sectors like autos and banking, which are highly sensitive to rising interest rates and consumer slowdowns. To survive the pincer, capital must be rotated into assets that carry both an industrial demand and a safety bid, like silver, alongside defensive public sector energy stocks that naturally hedge against oil spikes. This dashboard displays the crucial technical tripwires for the week. If the S&P 500 breaches 6,600, or if India's Nifty falls below 23,100, we will likely see a cascade of automated, systematic selling. Navigating this Monday morning reset means putting aside hopes for a rapid recovery. Success right now is about rigorously defending your capital against a prolonged global squeeze.